up ahead. Affirmative 612.
Time once again for another edition of the Wealthy Pilots Podcast. Mr. Osborn, rocking some green. It looks a little green anyway. I am, but in the nether regions. Since we're doing a little St. Patty's Day action today, my friend. Is it better to be good or lucky? So we'll talk about that this week. How you doing?
Good. Really good.
Yeah.
Nice. And really lucky, I should say. So both.
Well, there you go. Well, that's always good. So better to be good than lucky, right? So a little St. Patrick's Day lessons, I suppose, for investors. We always talk about the luck of the Irish this time of the year and, all that kind of stuff. And it's fun, right? There's a lot of fun stuff with that as well. But, is there any myth, I suppose, to lucky investors? Because there are some people who just seem to be, blessed or touched or whatever you want to call it.
Luck is an interesting thing. I actually read a book on it last year. I'll have to include the title. I forget the title of it, but it basically talked about how, some people are lucky, but a lot of times it's people that have, worked hard for certain things. They've built built circles of people around them, and they've set their life up in a way that allows them to kind of take intelligent risk, if you will. And then they, through that, they get what is perceived as luck, but many times
circumstances. They've definitely a lot of times have built something to where it feels like you probably know somebody, right? They're like, God, that's the luckiest dude or luckiest girl or something. There always something's going right for them. And it's, if you look out wider, maybe it's because they've cast the net.
Yeah, I mean, I got a golf buddy who's like that. Dude, his ball always hits a tree and ends up in the fairway. He blades a chip and it hits the pin and stays.
Okay, that is just lucky.
But he's like that in business too, and he just laughs about it. But it's like, okay, maybe there's some universal laws here at work too we don't fully understand. But I think when you take a step back and try to think about that phrase, it's better to be lucky than good.
Or good than lucky.
What's that?
Or good than lucky. It's better to be good than lucky.
Yeah, the historical phase is it's better to be lucky than good. And so, to me, I want to kind of turn that on its head today. But, I think in its eternal sense, that phrase applies in a lot of ways, right? Like, hey, maybe I can be a good driver, but being a good driver doesn't prevent you from getting T-boned by somebody running an intersection, so to speak. But
right.
So there's times where luck plays into it, where you go through, and then 30 seconds later, maybe somebody blows through the intersection. You never even knew you were lucky.
True.
So
yeah.
But I think when we look at least talking with a lot of our pilot clients, and you look at like the proficiency that they're constantly driving for in what they do. I mean, I think if to a man, you'll talk to them and they'll say, I want to be both good and lucky. And
especially as a pilot, in the air, it's like, hey, I'm good at what I do, but a little luck on my side would be nice as well. So.
We'll all take some luck. And so, when I thought about this from an investment standpoint, to me, I think we don't want to count on being lucky. It's not a good investment policy. It's not a good investment process.
Right.
And to me, like, we see people who I think are making decisions, and they think that they're being, really, a smart or, well intuited investor, but really they're taking risk in a way that they're hoping that they're lucky. Right. And so to me, like, I think a lot of the things that we look at that people will do that is really rooted more in luck than it is in any academic research or process or discipline. One would be like stock picking, right? Hey, sure. I've read some things, when you look at what, your standard financial analyst has gone through from a training standpoint, education standpoint, knowing how to read a balance sheet, knowing how to evaluate PE ratios and debt to equity ratios, and then trying to forecast the future earnings of a company, and then wind that back to get the net present value of the current share price, and then determine it's undervalued and we should own this stock. There's a lot that goes into that. I don't know too many people that are doing that kind of work when they're saying, hey, I'm going to go buy NVIDIA or whatever the case is.
Yeah, true. And then you have somebody who's like, oh man, they bought NVIDIA early, and they just got super lucky, but you don't know that they may have done a lot of research, or they may have also had a lot of other investments that were just terrible too, right? I mean,
it's partly that again, or it could have been somebody like I was saying earlier, where they've like they've set themselves up to be lucky because, hey, I've done so well in my other investments.
Yeah.
If this $100,000 goes to zero, it goes to zero, and I'm going to put it into NVIDIA, let's say, and I'm just going to leave it there forever, and. The people that did that got a huge payoff for it, but not many people have done that. There's many people that are trying their hand in a certain game here. And again, we just see a handful of behaviors that I think are rooted more in luck than they are in discipline, process, et cetera.
Yeah, and I think you got to have that discipline in that process. You were talking about golf earlier with your buddy, and I don't know if I've shared this story on the podcast or not, but years and years ago, I was playing golf with a friend, and he got a hole-in-one, his only one he'd ever had in his life, first one, on a par 3, right?
Yeah.
And his demeanor changed because he was like, oh, dude, I got the luck with me, and I figured this game out, and went on to have his worst round of his entire life,
Sure.
even with the ace, right?
Yeah.
And so because he got a little too cocky, right? So, the other guy we were playing with stayed with his traditional discipline because I'm just terrible. The other guy played with his discipline, and he just proceeded to kick the crap out of both of us.
Right.
So,
right.
Well,
I mean, and it's interesting because I think when you look at luck, right? I mean, we talked about stock picking. The other thing that I'll see frequently, to your point, some of the worst things you can have happen is to have one hit, because then you think, oh man, I got this game figured out.
Yeah.
Right.
Yeah.
And, you're not investing for your future. You're gambling your life savings, which is two very, very different things that are typically
pretty much
two very, very different outcomes.
Yeah.
And so, if I look at from a luck standpoint, okay, maybe stock picking one, the other one's going to be market timing. People frequently will fall victim to this trap. And I don't think they necessarily view it as a way to try to be lucky. Although that is really what it is, right? Hey, I'm hoping I called a top correctly.
Yeah. Or the bottom, which we're seeing right now, Scott, with everything happening, right? The market's been dropping the last little bit, all the conflict stuff. So people are going, when does he hit the bottom? When do I start buying the dip? Well, it's, who knows?
And that's just it too. I mean, that was the other side of that coin. I'm hoping I find the bottom. Right. And the person that engages in market timing, the challenge is you got to do that twice, and then you got to do it repeatedly, right? I need to call bottoms. I need to call tops and figure out when to move my money in and out. It's a significantly inaccurate way statistically to try to invest your money. It's very, very hard to call tops and bottoms. I think there's definitely some trends you can see when certain things are overweighted. That's
Absolutely.
why we believe in rebalancing. But, to make dramatic decisions based off of what's going on in the market and hoping you're lucky with calling tops and bottoms, and then to try to do that rinse and repeat over and over again, we just typically don't see that those accounts keep up anywhere close to people that just stay in the market and ride out the trend at times.
And you got to be right twice, to your point. I mean, my wife tells me I'm barely right once, so let alone twice. So I'm never going to get lucky enough to get right twice. So, all jokes aside, but it really is tough to do, and so, I mean, it's even why the greatest investor of all time is like, don't be in the market for 5 minutes if you can't, or 10 minutes if you're not prepared to be in it for 10 years, right?
Absolutely. Absolutely. Yeah. So the other thing I think is really interesting with luck too is, I'm sure in the cockpit you hear guys talking about, something that they did invest in that went really, really well. If somebody could routinely do that, they would be a billionaire, Yeah. Well, they'd be a billionaire. If you can routinely pick the right stocks and know when to buy them and sell them and trade them, you'd be a billionaire. I mean, that's what the best traders in the world.
And if they're selling you their program on how to do it, well, they're selling you the program. They wouldn't sell you it. If it actually worked, they wouldn't be selling it.
You see that online all the time for sure.
Yeah.
But the flip side of that is, for every one winner, this person could have 10 losers. And I don't think most environments I get around the quote unquote the guys, you don't spend too much time hearing other guys be like, dude, you should have seen these 5 stocks I bought that absolutely tanked. I mean,
right.
It's like
your good buddies might, but yeah, for the most part,
maybe. Yeah.
Maybe.
So, I mean, I think, it lends itself to say like, hey, I should have a good process for this, but I shouldn't be involved in certain behaviors that are really trying to assign more to luck and timing things out than it is to process and discipline. So,
Well, let's talk about what good investing actually looks like then, right?
yeah, I mean, so good investing, right? So to me, I think first and foremost, there's diversification, right? I mean, there's an element of like luck, maybe way out on this spectrum where I'm trying to
Sure.
get better results. And then there's an element of like, I do absolutely nothing and I probably leave a lot of opportunity cost on the table, right? I just take the target date fund that the company gave me and I leave it there. Well, there's probably kind of somewhere in the middle that we can, not try to get lucky, but we can try to get better returns through some known best practices, right? Being diversified, rebalancing, low turnover funds, low cost funds, and steady saving and investing. Okay. And, those things are tried and true. And again, market timing, stock picking, those are tried and untrue routinely. Right.
So
again, you might have somebody lucky here or there. You're
Sure.
going to hear about those people, right? You're going to have the guy that called a recession every year for 22 years straight. The recession finally happens and he's going to look like a genius.
And he's a genius. Yeah. So consistency, I would think, is obviously a big piece of being, good, right? Discipline, to your point, risk management, right? All of those things. And just overall long-term strategy too. I mean, not just winging it, right? I mean, again, the best pilots in the world, all of them have a strategy. They don't just wing it.
Yeah. I mean, there's a lot of, again, strategy, then a plan, then a process that's going to bring it over the finish line. And, it's not super sexy, but it's very disciplined. And so to me, I guess I would kind of summarize that like, okay, so at the end of this process, and I'm doing these things, right? So I'm doing discipline, saving and investing. I'm doing rebalancing. I have low cost funds that are diversified. They're low turnover. I buy things with the intent to hold them for a long, long time. Okay. If that's the rainbow, where's the pot of gold and what's in it? Okay. What does that get me? And so a couple things I wrote down here. First and foremost, compound interest. We do not want to disrupt the compound interest machine.
Okay.
We want to keep the machine rolling while you're sleeping. Okay. While you're sleeping and the market's down, your dividends are paying out and reinvesting, buying shares while they're low. You know what I mean? Like, don't disrupt the compounding machine.
Yeah. Give us an example.
Let's take the pandemic. Okay. Market's down 33%. Your dividends are paying out right in that quarter, end of March. You're buying those shares automatically where the cash from all the stocks you hold, the cash dividend from all those companies pay out, hit the account. And a lot of times you don't even see this going on. It's not when you have your dividend set to reinvest, it is not even, it's not showing up as transactions necessarily that you're seeing on the daily. If you dig into the reports, you'll see it. But, those dividends pay out and automatically are going in to buy shares at a discount for you. That's an example of, that compared to the person who's freaking out about the market going down and they're going to try to time it. Well, now they're all in cash. When they're all in cash, they miss out on all those dividend payments.
Yeah. Right.
And so, and then you're missing out on all those compounding returns. And
you're back to the time in the market, not the time, timing of the market. Right.
So again,
consistency. Yeah.
We don't want to disrupt the compound interest machine. We probably need to do a separate episode on that. Just, when you start going to cash a ton, like just the amount of, dividends you miss out on.
Yeah. Yeah. Well, think about this too, right? So consistency, time in the market, like we talked about. So like if you were putting 50 grand, just a quick example, $50,000 a year for 25 years at an average 7% return is like what, 3.5 million or 3.25 million, somewhere in that neighborhood. That's no luck required, right? That's just consistency, compounding interest, and time.
Yeah, I mean, and ultimately, if somebody was like, "Hey, I need to end up with $10 million to sustain myself in retirement," well, even with that, you want to say, okay, well, build a plan that's more risky, let's say, but that you're still hoping that you're going to go get the returns. I mean, you're going to have to probably do some other things like take some debt out and invest in private equity and things of that nature. But there's certain things that you can do that are a lot better than just trying to say, well, let's go try our hand here at some lucky strategies. So,
and somebody might hear that and go, man, 25 years to get to $3 million. And it's like, well, yeah, but again, consistency, right? I mean, that's and I think part of the problem is everybody wants to hit the home run ball, a little too fast, right?
Yeah. Well, and again, from a compound interest standpoint, I mean, it's the exponential curve, right? Just the way the curve works, that's at 25 years. Well, guess what? In another 7 at 32 years, you're going to have 7 million if you just keep doing the same thing.
Right.
And so, it's important to have that vision and then have the discipline to stick with it,
Yeah. Very true.
So anyways, yeah, I mean, I think at the end of the day, hey, we don't want to try to be lucky. We want to be good. All right. And there's a lot of things that we can do to be good. I don't know the things that we can do to be lucky. So let's control what we can control. Let's get a plan together, and then let's do the right things that we know we can do to be good. And if we're good and we let the market take care of us, the discipline and the process will have the payoff, and we'll get to that pot of gold down the road.
Yeah, I imagine there's not too many pilots, who wind up saying, let's just see if we get lucky with this landing, right? They follow the process, they follow the checklist, they follow the strategy, the plan, right? The training, all that stuff. So, if you need help, folks, with that kind of thing, it's, it is better to be good than lucky. Luck is great once in a while, but if you need some help with the strategy portion and getting good, then reach out to Scott and have a conversation, get some time on the calendar. We got links in the show descriptions down below. RetireAirlines.com is where you can find him online. RetireAirlines.com. Don't forget to just click on the link and set yourself up. Or if you want, you can get started with the toolkit. Molly will jump on here and tell you how to get that. Scott, thanks for breaking it down and wearing green, my friend. Have yourself a great holiday.
Happy St. Patrick's Day. We'll see you soon.
We'll see you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.